The US housing market has been flashing red for nearly 2 years. Record house prices, mortgage rates quadrupling from 2 to 8%, and a price-to-income multiples worse than in 2006. But so far, US house prices have seemed to defy gravity. Yet how long can they remain elevated? Will 2024 finally be the year where we see a major correction with a huge impact for the rest of the global economy? In the aftermath of a devastating credit crunch, the US housing market boomed, and this boom turned into a runaway train during the COVID pandemic. A combination of ultra-low interest rates, pandemic stimulus, and a shift to working from home caused demand and prices to soar. At the start of the pandemic, a $60,000 income was sufficient to buy a typical home. But by the end of the pandemic, the income required to buy a house had soared to $114,000, an income far higher than average salaries in the US. This has pushed home ownership out of reach for a whole new generation. And we can see that here in the ratio of house price to incomes, which has soared to a level last seen in the credit crunch. However, unexpectedly high inflation since 2022 caused the Fed to increase interest rates significantly, and with a strong recent economic growth, mortgage rates have risen even faster, with markets predicting higher long-term interest rates. Recently, the mortgage rate for a 30-year fixed deal rose to 8%, the highest level since 2000. Back in 2006, it required only a modest rise in interest rates to just over 5% to precipitate the severe housing crash. The rise in US interest rates is very significant. US bond yields have risen to the highest level since 2001, and this changes the dynamic of investment, and investors are big players in the US housing market. The cap rate is the effective return on investing in buying a house. It's the return you get on renting after paying for the costs. Now, despite recent rises in US rents, the cap rates have fallen because of a surge in house prices. This year, bond yields exceeded that of cap yields for the first time in decades. It means an investor can get a better rate of return on a safe investment like a government bond than it can from a more risky investment like buying housing, with all the costs and effort required to make it work. So far, the market has not reacted to this change in dynamics, but in the coming months and years, investors will find housing much less attractive than in the past. And as you might expect, with mortgage rates of 8%, demand for new mortgages has fallen to a near 30-year low, 22% lower than this time last year. The impact of higher interest rates has a delayed effect, especially with many people on a fixed-rate mortgage. So the effect of the higher interest rates we see now will have a big impact next year. So all this is a clear ingredient for a fall in house prices. Prices are overvalued, interest rates have soared, and many people just can't afford them. Yet in the past quarter, US house prices rose, suggesting quite a strange market. What's going on? Why are house prices rising when mortgage rates have risen so much? Well, there are 5 factors that can explain this recent rise. But the big question is, are they going to be enough to prevent a fall in prices in 2024? Well, firstly, it is a different scenario to the credit crunch in 2006. These days, most people are on a 30-year fixed mortgage deal, which means that many recent buyers have been unaffected so far by rising interest rates. American households are actually paying quite a low share of income in mortgage payments at the moment. 82% of homeowners in the US have a mortgage rate of less than 5%. Now, this will change over time, especially as new buyers face these new much higher mortgage rates. But it is very different to 2006, where homeowners immediately saw the rise in Fed interest rates. Secondly, American home builders have been much more cautious than in 2006. The boom in demand in COVID did not lead to a boom in house building. And this decline in house building has been exacerbated by a rise in the cost of building a house. Due to inflation, we've seen a near doubling in the cost of building a home. This has led to a shortage of supply across the country, squeezing prices even higher. According to Realtor.com, there was a shortage of about 2.3 million houses at the end of 2022, an increase of about 500,000 since the last decade. Thirdly, the shortage of homes for sale has been exacerbated by the interest rate rise. This is because many recent buyers can keep their very low mortgage deal if they stay where they are. So there's no incentive to move, because if you move, you'd face a much higher new mortgage deal. And the consequence is that very few houses are coming onto the market, and there's a shortage of properties that is keeping prices high. Fourthly, the US economy has actually been doing quite well. The US has achieved quite a remarkable recovery from COVID, especially if you compare it to other countries like Europe and the UK. The US has simply done much better. Also, if we look at real house prices, which takes into account inflation, the picture is less spectacular. At least part of the COVID boom in house prices was pure inflation. Robert Shiller, the author of Irrational Exuberance, who predicted the housing crisis of 2006, is much more circumspect this time around. He doesn't predict a big crash. He suggests that the market will go sideways or a modest decline of maybe 10%. He argues there was definitely some exuberance, but this was mainly people trying to buy a house at the ultra-low interest rates before they shot up. So with rates at 8%, this demand will evaporate. A fifth factor behind higher house prices is that in recent years we've seen near record inflation in rents. Rent prices have gone up quite significantly, making it more attractive to buy a house if you possibly can. However, very interestingly, in recent months, rents have started to fall, and the outlook for the next 12 months is that rents will fall because the number of new apartment buildings coming onto the market is at a 50-year high, with more than 460,000 been completed this year. And this increased supply of rented accommodation and the likely fall in rents will definitely put downward pressure on house prices, a close substitute. But despite these factors presenting a reason why house prices stayed high, others, such as Charlie Munger, are much more pessimistic about using housing and US property, and fear that 2024 could start to see bank losses and falls in property values. Firstly, the American boom in growth and demand for buying a house has at least partly been fueled by a very significant fall in the savings ratio. In the pandemic, savings soared, but this has been run down quite dramatically in recent months. So this strong growth in demand cannot be maintained by keep reducing savings, because nearly 60% of Americans are already living paycheck to paycheck. And next year, higher interest rates will increasingly bite as firms and households face higher debt interest payments on their loans, credit cards and other things. Another area of concern for the US property sector is in commercial property. The shift to working from home has seen a big fall in demand for office space. There's a big rise in vacancy rates from 12 to 18%. So with less demand, property values are starting to fall, especially in commercial real estate. And many small and medium-sized banks are at risk of bank losses, because when house prices fall, it's homeowners who face the cost of negative equity. But in commercial real estate, loan arrangements are different. Investors can walk away. The equity loss is covered by the banks, not investors. And the property estate market is not fully adjusted to both the new working practices with people working from home and also higher long-term bond yields, which has created much safer forms of investment which get a similar return. But the real risk to the US housing market in 2024 would come from the wider economy. If higher interest rates finally bite, if households really run out of money because they have no savings left, then it could lead to a long-anticipated recession. Falling demand and rising unemployment will have a very big impact on the housing market, as some people are forced to sell, and that would enable prices to start to fall. With very thin volumes, a small change in market conditions could have a big impact on prices. Now, if you're looking for optimistic news, the good news on the US economy is that after years of exceeding inflation forecasts, inflation has fallen faster than quite a few predicted. The inflation rate is now 3.7%, with core inflation looking even more promising, suggesting it could fall further. So should the economy slow down significantly next year, the Fed do have more room for manoeuvre in cutting interest rates because inflation isn't as bad as some feared. Certainly 12 months ago, few economists were predicting that inflation would fall so much without unemployment. However, if we look closer at the US economy, there are other reasons to be concerned. Firstly, 60% of Americans are living paycheck to paycheck with high personal debt levels. The US government is also running a record budget deficit for this stage of the economic cycle. The Inflation Reduction Act was ironically quite a big fiscal stimulus which helped boost investment and manufacturing. But how long can the US maintain this impressive economic growth from both government and private debt. US house prices are substantially overvalued compared to mortgage rates and price-to-income ratios. But with interest rates rising above returns from renting and US bonds, it will cause a big shift in investment over the next few months. Therefore, there is a strong chance that prices could stagnate or fall in the next few years. So although the outlook is pessimistic, it is important to bear in mind it's not as bad as, say, 2006, where we had a lot of subprime mortgages, very bad mortgage lending, and people very vulnerable to rising interest rates. This time, homeowners have better credit ratings, more equity, and fixed-rate mortgages, which will help insulate from the recent rises. The strength of the US economy is definitely an interesting factor, and that could change next year. Yet, if the economy is doing so well, why is it that so many Americans feel that they are poor? This is because many are not benefiting from the rise in GDP we see in the official statistics. And this is an aspect of why the housing market may be more vulnerable than the national picture suggests. This video goes into more detail on the apparent contradiction between very strong economic performance and why Americans are feeling poor.